New York Federal Reserve that was in charge of handling the AIG bailout. So let's paint a scene for people. He's on the board at Goldman. He's chairman of the New York Fed. While chairman of the New York Fed, he directs Tim Geithner, the president of the New York Fed, to pay all AIG counterparties at 100 cents on the dollar. Quick tangent. The CDS contract that they would be paying 100 cents on the dollar for were trading in the aftermarket for somewhere around 50 cents on the dollar. And Janet Tavicoli has actually said that most likely they would have brought about 20 cents on the dollar in the open market. Well, when our government stepped in, instead of handling the situation like they did with GM and Chrysler, where they put pressure on the creditors to accept haircuts, our government stepped in and said it would be way too complicated to provide to demand haircuts. So we're just going to go ahead and pay all counterparties off, full price, 100 cents on the dollar. You mentioned Societe Generale, $16.5 billion. The largest U.S. one was Goldman Sachs, almost $14 billion. So let's get back to Friedman. So here he is in New York with this information that the government, through AIG, will be giving Goldman Sachs $14 billion with no strings attached. See, this isn't like the TARP money where you would get preferred shares or warrants or some combination of the two. This was $14 billion of found cash. And this was material, non-public, inside information. And what did he do with this information? Well, he decided to buy 52,000 shares of Goldman Sachs when it was at its when the greatest fear was out there that Goldman wouldn't make it along with the rest of the investment banks. So the stock was trading below $70 a share. He buys 52,000 shares, doesn't get permission from the lawyers of the New York Fed in order to make that purchase. In fact, when Gretchen Morgenson of the New York Times exposed it, and the quote from the New York Fed lawyer Thomas Baxter was, "We had no idea he'd even made these purchases." So when the news hit, when Gretchen Morgenson wrote that article, Stephen Friedman resigned. But that was it. So he's still sitting with his 52,000 shares purchased at the bottom of the market for Goldman with material, non-public inside information, and we haven't heard a word from Mary Shapiro at the SEC.
I mean, come on. If that is not the epitome of the Wall Street, Washington incest where, protect your own, I mean, that seems like a slam dunk insider trading case.
I don't get it.
I mean, come on. And
I don't get it, Larry.
And it kind of goes along in passing, doesn't get the continued exposure. Again, I commend you for elevating that issue. I'll be honest with you, I did not realize that his name was raised by Representatives Issa and Towns. That fellow's supposed to get, certainly supposed to get arrested. Certainly, he's eligible for due process.
Right.
But let's have due process. I mean, if he doesn't if he doesn't have to play by the rules, and I guess this becomes the whole law of the unintended consequences and this perpetual violation of all these moral hazards. If they don't have to play by the rules, then what do I have to play by the rules for, right?
Right. It's stealing. Think of the Bear Stearns subprime hedge fund case that the federal prosecutors brought. I'm trying to talk quickly because I know we just have a couple of minutes left.
Right, we got about 3 minutes left.
Yeah, that case it fell flat on its face. The jury returned a not guilty verdict. That was a difficult case to make. These are fund managers who maybe or maybe didn't believe in the value of their holdings. This Stephen Friedman case is completely different. It is cut and dry. He was using information that no one else had. No one else knew that AIG's counterparties were going to get 100 cents on the dollar, and no one knew that Goldman's exposure was $14 billion. He knew both.
Amazing.
The fact that. So the fact that he's going to be brought before Towns is one, it's going to be a huge public embarrassment for him, and two, hopefully it'll put some public pressure on the SEC to perhaps at least investigate it.
Again, if